Hello everyone. Um, Having discussed two previous subtopics from the risk quadrant, it's time to look at financial risk and how these could originate and how they can be managed. Every business on the face of the earth strives to make financial gains. Therefore, any risks that particularly target organizations' finances are serious risks that must be addressed. Again, I am yours truly, Dr. Dennis Edogu. Financial risk has been defined as the potential for financial loss or instability within an organization resulting from various market, credit, or liquidity factors. We are going to see those factors shortly. Why is this important to us? They are important for three major reasons. It ensures business stability and continuity. It protects organizational assets. It fosters sustainable growth and success of the business. Therefore, organizations must carefully manage their financial risk. Here I present three main financial risks faced by most organizations, especially organizations that operate internationally. As you can see, interest rate, currency rate, equity price rate are the three major financial risks under the umbrella of what is called market risk. Interest rate is the risk that the value of a financial instrument or a company's financial performance will be adversely impacted by changes in interest rates. Business impact could be high interest payments on variable rate debt, reduced value of fixed income investment. Every business, or most businesses, so to say, take some credit or borrow some money from financial institutions to invest to make business. So when interest rate is high, it impacts the value of the business. Currency rate risk is another one. In international trade, different countries of the world have different currencies. In Canada, we have the Canadian dollars. In the United States, we have the United States dollars. In Britain, we have the pounds. And different countries manage their currencies differently. Now, currency risk, also known as forex risk, uh, this risk risk of losses due to fluctuations in exchange rates. Business engaged in international trade are more exposed to this risk. Most businesses uh, engage in international trade. The impact could be reduction in value of foreign earnings and increased costs for imported goods and services. Equity price risk is yet another market risk. This risk pertains to the potential for losses due to changes in the prices of equity securities or stocks. It could impact businesses in two ways: declining value of stock investment, reduced market value of equity linked compensation to stakeholders or stockholders. Credit risk is another one. By definition, credit risk is the possibility of a loss resulting from a borrower's or counterparty's failure to meet their contractual obligations. It could result from borrower's default or insolvency, counterparty failure to deliver obligations, downgrade in credit worthiness. A real-world example could be a customer fails to pay for goods or services received on credit, leading to a direct financial loss for the selling company. Just imagine, put yourself in the shoe of a selling company. You sell product or services to somebody or to a business and they refuse to pay. Of course, that will greatly impact your finances. Of course, there are redress that can be taken. You can use arbitration, you can go to court, but those are after the fact. Okay. Counterparty failure. In a derivative transactions, if one counterparty fails to fulfill their contractual obligations, the other party faces potential losses. Bond issuer default is another market risk that fall under credit risk. If a bond issuer defaults on this debt, investors holding those bonds face the risk of not receiving their principal or interest payments. A credit spread risk. Changes in credit spreads due to perceived credit worthiness can impact the value of existing exposures and future borrowing costs. Liquidity risk. Liquidity risk encompasses the potential inability to meet financial obligations when they fall due without incurring significant losses. It has two primary facets: asset liquidity risk, funding liquidity risk. Asset liquidity risk is the risk that an asset cannot be sold quickly enough at a fair market price to prevent a loss. Example, real estate properties that take time to sell. You may put your property in the market and for 1, 2, 3, 4, 6 months it may not be sold. Specialized machinery with limited buyer pool. The business impact could be huge. Many forced asset sales, many are forced to sell at significant discount during market stress, eroding value and impacting financial stability. For the funding liquidity risk, this is the risk that a company will not be able to meet its short-term debt obligations due to an inability to raise new funding or roll over existing debt. Example, unable to refinance maturing debt, capital market freeze preventing new funding, and the business impact can also be significant, can force distressed sales of assets or lead to bankruptcy even if the company is otherwise solvent. Therefore, having looked at these very critical or crucial risks that faces organizations, it becomes important to remind ourselves again about how they can be expertly managed. In risk management, we usually go back to the basis, which is the framework proposed by ISO 31000. It says, sit around the table and identify your risk. Ask yourself those what if questions and write and list all of the things that can go wrong. And one of the ways to achieve a robust risk identification is through stakeholder engagement that cut across brainstorming sessions with key personnel, usually key personnel across different functions within the organization. The cross-functional team input is very vital because risk can emanate from any part of the organization, any discipline or function. When you put everybody together around a table to brainstorm, we can then benefit from the diverse perspective from the different experts gathered. Another method could be the use of checklists. Comprehensive checklists, can come from industry best practices, regulatory requirements, historical risk patterns. A review of these can help us better understand the risk landscape in order to provide solution to this risk. Scenario analysis is another one, and it could use hypothetical condition modeling, stress testing financial models, potential outcome exploration. These use advanced analytics, to be able to predict the future based on historical data. And in the previous lesson, I showed a risk matrix which helps us to quantitatively rank different risk events. So, once identified, risks are assessed using a matrix that I just referred to, where you look at the likelihood or frequency and gauge the impact or severity of the impact. So, based on that, you are able to quantify your risk and make plan to address this risk accordingly. Here are mitigation strategies that can be adopted for either market risk, credit risk, or liquidity risk. Remember, we said market risk, credit risk, and liquidity risk are all part of the financial risk organization faces. So for market risk, we can implement hedging strategies using different derivatives. There are a lot of options available out there. We can use financial instruments to offset some exposures. We could regularly review and rebalance our portfolio as necessary. Credit risk, we can conduct thorough credit assessments. We can use credit default swaps for protection. We can establish clear credit terms and monitoring. Liquidity risk, we can maintain adequate cash reserves, stress test under various scenarios, and develop contingency liquidity plans. Don't forget, we identify, we assess, we design, we implement, and we monitor. This is the best way to ensure continuous surveillance. We evaluate the risk exposure that we face. We create mitigation plans or strategies. We put those strategies in action, and we continuously monitor, review through oversight function of leadership. Implementation is important as well as monitoring. We implement best practices. First, we establish clear roles and responsibility. Look, clear roles, responsibility, and accountability. So we define clear roles, define responsibility for risk management at all levels of the organization. We integrate frameworks. We can align risk management with existing business processes, and it's often advisable to start small. We can pilot some programs before organization-wide implementation. So when we start from a specific department or unit, we can learn lessons there as we implement that can be replicated across. Continuous monitoring is essential because risk changes with time. And with time too, new risks can emanate from the environment, from the financial environment, from the physical environment, from everything. So regular risk indicators can, must use tracker like dashboards to be able to see the picture, a clearer picture. You can do regular reviews or document, and it's a continuous and cyclical process. Again, the structure is usually identify your risk, assess your risk, mitigate, monitor, review, and you continue with the cycle. In order to build a risk-aware culture across the organization, communication plays a key role, and there must be a transparent risk reporting. This can also be legally binding on some organizations. Risk education is key. We must continuously train and retrain everybody across the board, not just one department called the risk or safety, whatever department is across the board. Accountability, clear risk ownership must be established and maintained. Again, risk management must be built into the organizational culture through leadership support. Leadership support, proper management, tense management, and involvement of employees. Ladies and gentlemen, here are the key takeaways from today's lesson. Proactive financial risk management is a strategic imperative, not just a defensive measure. Systemic identification and assessment of risk enables targeted mitigation strategies. Cultivating a risk-aware culture ensures practices are embedded throughout the organization. Effective risk management transforms potential threats into opportunities for resilience. When this is done correctly, here are the strategic advantages: business stability, growth foundation, competitive edge, stakeholders trust. Don't forget, proactive financial risk management turns potential threats into opportunities for resilience and competitive advantage. You can quote me on this. Again, thank you very much. I appreciate your engaging with my content, and don't fail to like, comment, and subscribe for more Richmond insights. Tell us below, what's your biggest takeaway from this very lesson? I am yours truly, Dr. Dennis Edegun. I will see you in the next lesson. Thank you.